Four metals, one question. Where do prices go from here? Gold, silver, platinum, and palladium are all drawing fresh analyst attention as we move deeper into the decade. Macro uncertainty, shifting industrial demand, and central bank policy are all pulling at prices from different directions. Here is what the outlook suggests. Gold remains the standout performer of the precious metals complex. The rally has been driven by three forces: central bank buying, persistent inflation concerns, and geopolitical tension. Whether those tailwinds hold through 2026 comes down largely to one variable: the Federal Reserve's rate path. When real interest rates fall, the cost of holding gold drops with them, and that tends to support prices. If the Fed moves toward easier monetary policy and keeps it there, analysts expect that dynamic to continue working in gold's favor. Silver is harder to call. It tracks gold directionally, as a monetary metal tends to do, but it carries an additional layer that gold does not: industrial demand. Solar panels, electronics, and the broader energy transition all consume silver. That means silver is more sensitive to global growth expectations. A manufacturing slowdown would hit silver harder than gold. On the other hand, a strong industrial cycle could narrow the gold-to-silver ratio, the number of silver ounces it takes to buy 1 ounce of gold. And historically, when that ratio compresses, silver tends to outperform. Platinum and palladium present a more divided picture. Platinum has traded at a persistent discount to gold for years. Some analysts see room for that gap to narrow if hydrogen fuel cell technology drives new demand. Palladium is in a different position. It has retreated sharply from its highs as the auto industry gradually shifts toward battery electric vehicles, which use far less palladium than combustion engines do. Both metals are heavily sourced from Russia and South Africa, which means any supply disruption can move prices quickly. Across all four metals, the common variables for 2026 are the same: the direction of the US dollar, the pace of global rate cuts, and whether the world's major economies can avoid a hard landing. A weaker dollar tends to lift dollar-denominated commodity prices broadly. Slower global growth could dampen demand for industrial metals while making gold more attractive as a defensive hold. Forecasts across the range of analyst estimates are wide right now, which itself tells you something. There is genuine disagreement about inflation persistence, central bank intentions, and geopolitical risk. Rather than anchoring to any single price target, the more useful approach is to track the Federal Reserve's policy signals and global manufacturing data as they come in. Those two data streams will tell you more about where these metals are heading than any forecast made today.